Welcome back to Fast Market, everyone. Kevin Hinks, Nick Theodorakis here for our middle segment, our hashtag segment of today's show. Now I want to bring in co-founder of LikeFolio.com, Mr. Andy Swan, to the show. He's going to talk about our feature stock of the day, and that is Disney. Andy, this company has so many parts that are making money and working, yet this company continues to get judged by streaming numbers. What are you seeing in terms of Disney? What is LikeFolio's information giving us today, Andy?
Yeah, on streaming, we've been, at LikeFolio, we've been watching this ever since it launched. It was a phenomenal launch. I think, pretty much anybody that had any ties with Disney whatsoever got in on that when it launched. And since then, it's been a little bit of a disappointment. The deterioration has been very real. I think it's one of those streaming packages that is the easiest for a lot of people to cut when compared to a Netflix or some of the other providers. LikeFolio data really shows that people are talking about canceling Disney Plus at a much higher rate than they were a year ago. They're talking about subscribing at a much lower rate. They're talking about watching the shows, which is even more concerning, at an even lower rate. And so I think, Disney Plus has some very real problems here after a absolutely gangbuster start. There's only so much you can watch, I guess, the archives of Disney before you start to demand new and compelling content. So I don't think that they're delivering on the promise there, and consumers are calling them on it. So I think if you're going into this earnings report looking for a blockbuster, streaming line item, then you're going to be disappointed. On the other hand, if you're going into this looking for a blockbuster outlook on the parks and that live entertainment revenue, I think you're going to be in really good shape. We're seeing people going to the website specifically where people plan their Disney vacation. They buy the tickets, they get all the information. That's up 21+% year over year. Really good shape. And I think with kind of the China reopening, that's another wild card for Disney. So I think the in-person aspect of Disney is firing on all cylinders. It's the streaming aspect that we worry about. And of course, you have a new CEO, kind of meet the new boss, same as the old boss kind of thing. and we'll see where that goes. That's the big wild card. What are they going to sell off? What assets are they going to sell off? And what's the strategy going forward? I think we'll have a much larger impact on this earnings report than what they did in Q4.
Andy, I was looking at some of the year-over-year numbers, and obviously last year set a crazy precedent for return to park. And I saw 82 or 83% over return to park over obviously the prior year when they were largely shut down. What do they need to do there to drive the stock price? I agree with you that I think that the streaming is going to be down a bit. There's not a bunch of new shows. Mandalorian comes out, I think, in a month or so. I'm watching the Andor show. I'm that Star Wars geek, and I think it's pretty fun. But, aside from a couple of Star Wars things, there's not much new content out there. What do they need to do from a park perspective, do you think, to really drive that number, given last year was such a crazy year from a comps perspective?
Yeah, I think the answer is really simple. And, all of the, moms of 4 or 5 kids out there, close your ears, but they can raise prices, and they can continue to raise prices because demand is there and they have the best experience in town by far. And that's the easiest way for them to drive revenue, because I think no matter what they do, the parks are going to be full in 2023. It's just how much out of each wallet do they get? And they have the pricing power. They have the ability to do it without a doubt. They don't have that on the streaming side, but they do have that on the in-park experience. And I think that will continue to be true for years to come.
Andy, this stock activity during 2022, it felt like a roller coaster. It felt like I was on the Matterhorn bobsleds and with some of the moves here. But Andy, should they take anything from the good Netflix number? Now, this stock has rallied through January, but that's not saying anything. Every stock has rallied through January. Bob Iger, like you mentioned, is going to go through his first conference call in a while. They're looking for an increase in revenue of 7%, but a 25% decrease in earnings per share, Andy.
Yeah, I think there's pressure already on him to cut some of these underperforming assets, and I think he'll do it. I don't know that there will be a big announcement but I think there will be a strategic plan unveiled. And, quite frankly, he's good enough and Disney's good enough that you kind of have to trust that if something like that is coming, it's probably going to be pretty good, and it's probably going to be along the lines of what Wall Street wants to hear. And so that's the best case for the bullish case, I think, here. As good as the parks are doing, it's really going to be about, how do people react to the new CEO's new plan? What is he going to get rid of that's weighing down the company, and what is he going to focus on? I think he's a good choice, and I think he'll execute on that really, really well.
Yeah, he talked about Disney Plus being profitable by 2024, but he gave it a big, assuming no shift in the economic climate kind of disclosure there. So, yeah, they've got a lot of work to do, but this is still a massive company doing a lot of things extremely well. Andy Swan, co-founder of LikeFolio.com, thank you as always for coming on and sharing some of your data. Have a great day, Andy.
Thanks, Andy.
Thank you, you too.
All right, Nick.